Hello and welcome back. It's that season of the year where we get you a lot of managements regarding their results and really what's happening in. One such management is Raymond Limited. Mr. Amit Agarwal, Group CFO at Raymond Limited, is now with us. Sir, thank you so much for taking out time for us. Q2, of course, would have continued to see an impact of the ongoing COVID issue. This quarter too has seen an EBITDA loss. Have you looked at cost rationalization methods? Are you looking at EBITDA turning around soon?
If you look at it, there has been a significant progression. If you see from the quarter one numbers, quarter one to quarter two, you have seen already more than 3x of recovery happening. Now, if I look at it progressively during the quarter, because July and August were severely impacted with the various lockdowns, which was not a central wide lockdown, it was rather a state or a city wide lockdown, which obviously prevented the consumers to come to the stores. But September, if I look at a week on week basis or month on month basis, what we see between July numbers to the September numbers, there is already three times grown. So for the quarter, you have seen this muted numbers. However, if I look at it from a month to month perspective, we have seen a good development. And if I look at it now going forward, very clearly, Raymond is such a brand which is very well respected for the festive season, very well bought for the festive season as well as the wedding season. And we all know that the wedding season is on the anvil, and there are many wedding that is going to happen in this year, in this winter, vis-a-vis what has happened in the summer. In terms of festivity, we all know there has been a lot of people who have not been able to spend money. They have come forward, and we have witnessed. If I look at in our stores, all our stores are running at this juncture. At this juncture, if I look at it, especially tier 3 to tier 6 cities, they are actually reaching to almost like 85-88% levels of pre-COVID levels. It is only the tier 1 and 2 we are still seeing a little bit weakness in terms of, let's say, they are at that range of 70%, 70-72%. But now we are seeing a much better traction, considering the malls have got opened, considering that you have the cinema theaters got opened, restaurants have got opened. So people have started to come to the malls, and then the shopping will happen.
So domestic cotton prices have increased in the last couple of months due to an increase in the demand. How do you see this impacting your cost? Also, what is the outlook for RM cost going ahead?
Yeah, that's a good point, because if I look at it in terms of a raw material, wool continues to be at a lower level, but we have adequate inventories available with us. So with the effect of the lower wool prices, we will see only in the, let's say, fourth quarter. However, on the cotton prices, because the Cotton Corporation of India, we keeps on selling and moving the prices to a great extent. So we have seen a volatility in the cotton prices. But, Raymond Pese as a brand has a phenomenal brand value, and the raw material prices does have an impact, but it does not make so much of a difference because of the kind of the premium pricing which we enjoy in the marketplace, because people will want to come and buy a Raymond product, and the kind of unique designs which we have launched. Like, you will be well aware, if you have been watching the TV recently, that we have launched Vira Safe, which is our unique product launch, which has the antibacterial, antiviral kind of a fabric. And we have done very well. In October, we launched, and I think close to 3.5 lakh meters, we have booked that order, which is again a very, very good sign that people in the fabric space keep on looking for the newer developments which happens in this industry. And Raymond has been a pioneer and a front runner in terms of the new technologies, the new fabric, new design, new styles. I think that has been the, so to speak, the ethos and the DNA of the company.
And what are the discounting trends, and what is the impact of that on your overall margins? How are you managing your overall liquidity and your working capital management?
So let me first cover the discounting part. Discounting, obviously the end of season sale in the quarter two, which is normally for 45 days or so, has extended. There's no doubt about it. So that has been extended, and that has impacted our numbers. And you very well know that we went also more aggressive on the online marketplace, which the online marketplace has obviously a lower margin compared to the margins which you make on the brick and mortar store. So clearly that has an impact. However, going forward in the wedding season and the festive season, we are not seeing so much of a discounting. We are absolutely not seeing much of a discounting. As far as the working capital management, you see clearly on a net working capital, we have reduced by 500 crores vis-a-vis March. And clearly in terms of liquidity management, I think the company has been able to do a good job by keeping the debt levels in spite of the one of the most challenging period, I would say. Recall that after the pandemic in a retail sector, you have not increased the debt levels and maintained the liquidity at the level of 600 crores, and the net debt level of close to 1800 crores, which has been 1859 crores, let's say at March, and today we are at 1817 crores. So a shade slightly lower, but all in all, I can say the net working capital management is very, very focused. And one very important reason you need to understand with us is that our relationship with our dealer network and the franchisee network goes back. Some of these people are along with us for 50 years. So what they have come forward is that though they have not been able to make sales, but they still went out and paid money, and we were able to reduce our receivables. They have seen some traction on the secondary market, then they took some of the primary material. So to that extent, what we did was we started to use our inventories which are available with us, be it on a WIP or FG, that to ship to them. So all in all, I can say the working capital management and liquidity is clearly a top on the agenda for us.
Okay, and how much of your total business and your sales are now coming from online versus what was there before, and what is your plan for leveraging your digital as well as your omni-channel part of the business?
So look, very clearly in terms of the brand, we know that the omni-channel presence is an important piece in today's scenario. However, if I look at the sales, the online sales are not going to be ever close to the brick and mortar sales. It will be a smaller number. However, our presence on the online has increased dramatically. We have increased our presence through an omni-channel concept, and from the online, what we were doing in the last year compared to that, I think we have grown almost 3x compared to the last year.
Raymond has shut about 61 stores in H1. Are you looking at closing more loss-making stores in H2? Will it be focused more on the MBO formats?
So I'll tell you what is happening in terms of our store planning and process going forward. We have identified certain stores which do not generate adequate profitability as we expect. And it is a business where you need to revisit this every year in order to see. You can start a store on a certain premise, which may turn out to be what you started with, and it may see some stores doing exceedingly well. Some don't do well. So you have to keep on rationalizing that. And that is the process which we are currently on. And I will not say that we will not take a closure of the store. We will take closures of the store, but also we will be opportunistic there. If there is some great location available, considering that many people are moving out of the malls and such things, we will also be opportunistically opening up some stores. So it is a rejigging the portfolio of the stores where you are placed, whether it makes sense for you, or you shut that and open a new one into a more vibrant and what you call customer responsive areas. So that has been the philosophy. We will continue to do so.
So there seems to be an anti-China wave in the US brands. Are you looking at alternate sourcing from other countries ex-China?
Yes, absolutely. I think this is very, very important. And it is not just seen in our fashion business or a branded apparel or a branded textile business. We are seeing in all other sectors. So let me first start with the lifestyle business. We have seen very clearly some of the major international customers who have bought maybe with from us, let's say in 2014, 2015, and because of the pricing or whatsoever so be the reason, they had moved to China. They are coming back with the inquiries, and clearly those inquiries are not smaller ones, they are a substantial ones. And when these in a fashion business, what happens is you need to take time because the designs get established based on the designs, then the patterns. So it is at least a 1 to 2 seasons away. So today we are in the process of finalizing this, but the impact or the revenue generation around that will happen only, let's say, in 2 seasons or 1 to 2 seasons later. Now, if I look at in our auto and engineering business, clearly some of the players who have been buying and large European
Thanks
OEMs.
so much, sir, for taking out time for us. Always good to get perspective from you. On that note, we're taking a break. Coming back quickly. Stay tuned.